Section 5.6, Credit Score, Good Loan Decisions, and Good Insurance Decisions. This section will help you understand your credit score, make good loan decisions, and also make good insurance decisions. So understanding your credit score. Start with the definition. A credit score is a number that represents the credit worthiness of a person and the likelihood that that person will repay a loan. The FICO score is the most widely used credit score, and the FICO scores range between 0 at the lowest all the way up to 850 at the highest. The benefits of a good credit score: lower interest rates on car loans, credit cards, etc. Renting landlords often use credit reports to screen prospective tenants. Employers use credit reports to screen prospective employees. Car insurance companies offer lower rates to people with good credits. Cell phone providers require a credit check to qualify for a phone plan, and also lower mortgage interest rates if you have a good credit score. And so here's how at least here are the top 5 things that affect your credit score. So the FICO 5. So pay rent history is 35% of that decision. The amount of debt you have already is 30% of your score. The length of credit history, 15%. And if you just open new credit, that can lower your credit score, actually. So a new credit is 10%. And then if you have a mixed credit type, so different types of credit, maybe a credit card, maybe a car loan, maybe a house, a mortgage, those sorts of things, a mixture of those can also improve or take away from your credit score. Okay, now go ahead and pause your video player and answer this practice question, which is a real-life credit score decision. When you're done, hit play to see how you did and see if you made the right choice in terms of improving your credit score. All right, practice 1. Let's say your only credit account is with a credit from Acme Credit Services. You are carrying a $5,000 balance on this card. The card has a fixed interest rate of 15.9%, and the credit line or the credit limit is $10,000. One day you receive an offer in the mail from Bank Uno Credit Services for a credit card with 7.8% fixed interest rate. That's much better than what we have currently going on here, which is 15.9, at a credit limit of $8,000. So that's a little bit lower than the credit we had before. Sure, you're making your monthly payments to Acme with no problem, but dollar signs start flashing in your head as you think of all the interest you'll be saving by transferring your balance from the Bank Uno card over to this transferring your balance to the Bank Uno card from our Acme card. Decision time, what should we do? Option A, sign up for Bank Uno card and transfer all the money and close your Acme account. B, sign up for the Uno card, transfer all the money but keep your Acme account open. C, sign up for your Bank Uno card, transfer half of your money and leave the other half in your Acme account. D, do nothing at all and leave all your money in the Acme account. Which option is the best for your credit score? Explain your reasoning and your choice. Well, I think the best option for your credit score is going to be B. Let's take a look at why that is. So which did you pick? A, you accept the offer from Bank Uno, transfer your balance over, and close your Acme account. Originally, you had a $5,000 balance on a $10,000 limit, so you're using 50% of your available credit. The new Banco Uno card has a limit of $8,000, so you're going to be using 62.5% of your available credit, lowering your score. On top of that, since your Bank Uno card is brand new, your credit history now is shorter, and your credit score will drop because of a shorter credit history. B, which is the one we wanted to choose, sign up for the Bank Uno card, transfer all your money, but keep your Acme account open. Even if you never use your Acme card again, this is the best choice. You save money because you've lowered your interest rate. You keep the good history that you've built with your Acme card, and you'll now be using $5,000 out of a potential $18,000, because now we're going to add up both our lines of credit limit. So we're using $5,000 out of $18,000. So notice we've lowered now the percent of the credit that we're using. So note of warning though, don't continue to lower your debt percentage by opening more lines of credit. You don't want to keep accepting credit card offers. You don't want to keep accepting credit card offers. If it looks like you're accumulating more available credit than you need, that also will lower your credit score. So C, while this option does everything that B does for your credit score, you'll be paying a higher interest rate on half of your money in the Acme account and wasting money. So that didn't make a lot of sense. D, do nothing at all. Will keep your credit score the same, but you end up paying a much higher interest rate than you need to. Tips for improving your credit score. Things that have a good effect on your credit score. First and foremost is paying your bills on time. Then, using 33% or less of your available credit. So basically less than one-third of your available credit, and then a steady employment history. Things that have an adverse effect on your credit score. Late or missed payments, using over 80% of your available credit, gaps in your employment, too many new accounts with credit limits that are higher than you need. So getting an account with a credit limit that's higher than you need, it actually puts you at risk because you could use this credit when you can't afford to pay it back. So here's a little choice here that we got from credit.org. So here's a little chart here that we got from credit.org to show you that if you have poor credit, how that affects everything. Notice your interest rates here are 9.5%, car loans almost 19%, insurance rates are higher, and credit card rates are also higher if you have poor credit. And so as we work down though, as your credit gets better, notice all the way up here to excellent credit, notice how much the home mortgage percents have dropped, car loans have dropped significantly, and also credit cards have dropped, rates have dropped significantly. And also, if you have excellent credit, then you also have, you're more likely to get rewards here with your credit cards, like cash back or certain incentives or things like that if you have a good credit score as well. So how to check your credit. You can pay usually around $8 to get your credit score, but you can also get up to 3 free credit reports each year. And I think this is changing a little bit. I've recently heard on the radio about free credit scores. Obviously, take everything with a grain of salt and be careful about that, but I think you might be able to get your credit score now for free in certain places. But if not, you can check your credit report. And a credit report just has a history of your credit and anything that's adversely affecting your credit. And you can get that by following these 3 steps here to check your credit report and make sure there's nothing on there that shouldn't be affecting your credit. Let's take a look at example 1 now. Use the chart on the previous page to determine the credit card APR that a person with a credit score of 635 would expect to pay. So I'm going to scroll back up here to the chart. Credit score of 635. So 635 is going to be in the acceptable range, and we wanted to know what a credit card rate would be. So that is 13.9%. Okay, go ahead and pause your video player now and answer practice question 2. Use the chart in the previous page to determine the auto loan APR that a person with a credit score of 400 would expect to pay. So we're looking for an auto loan, credit score of 400. Credit score of 400, so we're up here in the poor credit score area. An auto loan is now going to be 18.9%. Go ahead and pause your video player now and answer practice questions 3 and 4. When you're done, hit play to see how you did. So using your Easy app and the chart on the previous page, calculate the total cost of a 5-year car loan, $9,700 for Donna, who has a credit score of 780. So to do this problem, I think it's going to be easiest if we just use the simple loan calculator. So on your Easy app, open the loan calculator. The loan amount is for $9,700. The interest rate is, well, we need to figure that out. So the credit score of 780, and we're looking for a car loan. So great credit score, looking for a car loan. Car loan of 5.1% is what we would pay. So 5.1. Length is 5 years. Calculate. The total cost, we want to know the total cost. So the total cost for this car is going to be $11,010. That's the total cost. Now let's take a look at practice question 4. So the same thing now, 5-year car loan, same amount of the car, except now we have a credit score of 560. So that's going to change the auto loan rate we can get. So let's look up here at a credit score of 560. 560 is subprime, so our auto loan is going to be 17.9%. So all we're going to do is go into our Easy app now and change that 5.1 to a 17.9. Calculate. Okay, so how much more does a car loan cost for Rachel? So here's Rachel's price. When we calculate this in the Easy app, it's going to be $14,747.40. So $14,747.40. So that's going to be significantly more than Donna, who had $11,010. So let's do the subtraction there. So Rachel paid $3,677.40 more for this car. Same car, everything the same, just because she had a lower credit score. Making good credit decisions. Bad credit? No problem. We can get you financing. While this may be no problem for the company offering the loan, it's a big problem for the person usually borrowing the money. So here are 5 types of loans that you would like to, in your lifetime, try to avoid. Now, sometimes we cannot avoid them, but if we can, you always want to try to avoid these types. So, automobile loans for consumers with bad credit. The salesperson will tell you that you can refinance in a year or two once the credit is better. By then, the car has depreciated and is worth less than you owe, so you can't refinance because you're basically underwater. And so you end up stuck in a bad loan and pay almost twice the value of the car. Payday loans. You get charged a ridiculous daily interest rate, and the loan creates more debt than you can repay. 80% of people who take a payday loan need another payday loan within 14 days. So you kind of get caught in this cycle of debt that you can't get out of, and the daily interest keeps building against you. Auto title loans. So you're offered a loan and use your car as the title as collateral. With interest rates as high as 89%, these loans are a disaster waiting to happen. Mobile home loans. With interest rates as high as 19% and a very fast depreciation rate, meaning the mobile home loses value very quickly, there's no chance to refinance it, so you end up paying a lot more than you would for a house just to have a mobile home. Quick personal loans. The interest rates are so high you could end up paying $5,800 in interest on an original loan of $5,000, so more than you actually borrowed. Worse, many companies encourage you to buy credit life insurance, which pays the loan if something happens to you. So, ominously, the insurance really doesn't look out for you, the customer. It looks out for the insurance, the quick loan, the person selling the loan to you, so that they get paid in case something happens to you. So how do you know if you're walking into a bad deal? Here are kind of the 10 warning signs of predatory lender. Somebody's trying to take advantage of you. Number 1, where you're encouraged to provide false information about your finances. 2, where you're asked to leave a signature lines or any of the lines on any form blank. 3, did the lender alter any information you entered on your loan application? 4, are any disclosures missing? The good faith estimate, special information booklet, truth in lending, HUD-1 settlement. People are required that are lending money. They're required by law to provide you with these things. 5, have you refinanced your loan several times? In each instant, has the monthly payment increased or the total amount you owe increased on your home? 6, is your loan amount higher than the value of your home? 7, did you incur any unexpected costs at settlement? 8, after settlement, were you surprised to find that the monthly payments on your mortgage loan were higher than you anticipated based on the initial disclosures? 9, if you have a balloon loan, will you need to obtain another loan to finance that final lump sum amount? 10, were you required to buy credit life insurance? Again, credit life insurance is just protect the lender there, because it says it basically pays off your home if something happens to you or whatever you're getting money borrowed on. So credit life insurance really is only advantageous to the lender. All right. Practice question 5. Capital Money Lender is a lender matching service that arranges short-term loans for consumers. Go ahead and pause your video player now and answer this practice question about capital money lenders, and then hit play to see how you did. In minutes after submitting your information, you'll begin receiving loan offers from companies for up to $1,000. Choose a loan and it will go straight into your bank account. To repay the loan, just make sure you have enough money in your bank account when your payment is due. The APR of these loans range from 260% to 1,825%. But they're designed to be repaid in a short period of time, so interest rates are comparable with overdraft fees and insufficient funds for bounce checks. How could this loan work against you? Well, there's lots of ways this loan can work against you. Notice, to repay the loan, you just make sure you have enough money in your bank account, which means you're signing them access to your bank account. So you don't have a choice when you pay. As long as there's money in your bank account and you owe them money, They will take the money out of your bank account. So that's number one. It's not like you're choosing to make this payment or choosing to do another something else. They're going to take that money out of your bank account. The interest rates on these things are crazy. 260% to 1,825%. If you let your money roll in this, with this kind of interest for very long, you're gonna owe more than you borrowed. All right, let's go ahead and examine now practice question 6, and when you're done, hit play to see how you did. So Car Megastore has a great looking car for $11,500 that you want to purchase. It comes with a 6-month, 6,000-mile warranty. Even though you have less than perfect credit, they're going to finance you so you can drive the car home today. You need to pay $39 down with an 18% interest rate on the financing. The 6% sales tax will get rolled into financing. You also need to pay a $100 licensing fee at signing. So 18% interest rate, 6% sales tax. They tell you your payments are going to be $424.57 a month for 4 years. Use your Easy app to double check their calculations. How could this loan work against you? So let's make sure first that their monthly payments are accurate for borrowing this money. So let's check that with our Easy app. To double check this payment, we need to first take our $11,500 and calculate 6% sales tax when we add 6% sales tax to that. So that's what I've written here. $11,500 times 1.06 gets us up to $12,190. We also have a $100 licensing fee at signing. So we're going to add $100 to that. So that's going to give us $12,290. So that's how much we're going to owe for this car. Now notice we're going to pay $39 down, so we're subtracting $39. So $12,290 minus 39 is going to give us $12,151. So this is the amount we're financing. So that's what I'm going to put into my Easy app here. So that is significantly lower than this $424.57. So we would want to, at this point, it's possible that we made a mistake in our math here as we were looking at this thing, but it's also possible that somebody's tried to pull a fast one on us here. So we would sit down and have them go over the math and the payment plan that they have here, because that's significantly higher. You know, that is that's about $60 more a month, which over time would add up to a lot of money. Okay? So how could this car loan work against us? Well, first thing, it looks like they might be taking advantage of our payments. The next thing, too, is that looking at our Easy app, even if we get payments like this, $356 according to our calculations, we're still going to be paying $17,133.12 for this car. And this car is an $11,500 car to start. So we're paying a lot of interest on this car over time. So that's not in our interest here really at all. Making good insurance decisions. Some insurance coverage is necessary, including home, health, auto, life, and long-term disability. But narrowly focused single-purpose coverage on things like accidental death, cancer, credit card fraud, and mortgage insurance is redundant, unnecessary, and impractical, and a lot of times downright wasteful. Ready to trim your insurance costs? Here in alphabetical order are 14 policies you can probably scale back or live without. So if you have some of these policies, you might want to investigate to see if it's a good idea for you to have them. So number one is accidental death insurance. Well, a good life insurance plan covers accidental death, so that plan is redundant if you already have life insurance. Automobile collision. Now, most can go without. A deductible below $1,000 is usually wasteful. So I know that sounds like a lot to take into consideration, but automobile collision is something that you might want to consider. And basically, you just keep as much coverage as you can afford. So if you can afford $1,000 hit, then you can have $1,000 deductible and lower your payments, your insurance payments by quite a bit. Automobile medical. Most health insurance is going to cover you for that already. Dreaded disease insurance. Well, a good life insurance covers that. Car repair insurance. You're better off saving the money to pay for repairs. Your money can be used for any repair, not just the specific breakdown repairs covered by the insurance. Credit card payment insurance. Life insurance covers most of the time covers enough money to cover your debt of credit card and other debts. Credit card fraud insurance. Federal law prohibits more than $50 liability, so if somebody takes your credit card and charges a bunch of stuff on it, you're only responsible for $50, nothing more. Extended warranties. Most products already have warranties, so this is redundant. Flight insurance. Air travel is safe, and life insurance covers you if something was to happen during a flight. Flood insurance. It only covers the furnace and appliances, no personal property. So all it does is cover basically the appliances in your basement, none of your personal property. Life insurance for a child. Children do not usually provide for the family, so if there's something happens to a child, it's horrible, but you don't have to rely on their income for the family. Mortgage life insurance. So life insurance covers money to cover debt, so you don't need to have insurance on your mortgage. Optional group life insurance. Great if you're unhealthy. So if you're in a group plan, usually if you're a healthy person, you don't want to buy group life insurance. But if you're an unhealthy person, group life insurance is great because then you're kind of put into a pool of other people and that will lower your rates. But if you're a healthy person, getting life insurance on your own, you'll always get a better rate. Rental car damage insurance. If you have full coverage on your own personal car and or your credit card covers damages, then it's not needed. So this is something to check on, and this is something that I do. Check before I go and I rent a car. I want to make sure that I have coverage. So I call my insurance company and I say, hey, am I going to have coverage on my rental car? And if they tell me, no, you're not, then I check with a credit card, because certain credit cards will cover you if you use their credit card to rent the car. And so I've done that before too, where my credit card covers any rental damages. So something else to consider, not just financial, but there's an emotional side to insurance decisions. So you also want to consider your emotional ability to pay a high deductible or to pay a bunch of money if an accident happens. So people have different tolerances for risk. If you're the type of person who is going to be very upset when you have to pay a $1,000 deductible, then you might want to consider paying a little more for your insurance. However, if you have a high tolerance for risk, or you can see yourself through an accident that costs you $1,500 because you're saving money in the long run by keeping less insurance, then you should consider higher deductibles. Emotional well-being is an important part of life, so your risk tolerance should also be a part of your insurance decisions. Okay, go ahead and pause your video player now and answer practice question 7. Practice 7. Semco Energy offers interior gas line coverage for $4.99 per month. If a leak or break occurs, they will repair it at no cost to you. This covers the gas lines from the meter on the side of your house to the shutoff valves at your appliances. The odds of a gas line leak or break is extremely small between the meter and the shutoff valve. Most of the time, if something's going to break, it's going to break on the appliance itself, and that's where you're going to have a gas leak. The average cost to repair a gas line is $257. Is this a good insurance purchase? Include calculations to support your answer. Well, I personally don't think this would be a good insurance decision for me, because we're talking about a gas line break, which is extremely small. The chances of breaking a gas line is extremely small. Really, the only time that might happen is if somebody is actually working on the house and they accidentally hit a line, and usually the person that hit the line and broke the line is going to be the one responsible to fix the line, not necessarily Semco Energy. The other thing here too is we have this $257 average cost to repair the gas line. So let's take $257 and let's divide it by $4.99, and let's figure out how many months we would have to pay before we break even here. So $257 divided by $4.99. That is 51 and a half months. So basically, let's say 52 months before, if you saved $4.99 each month, at the end of 52 months, you would have that amount of money. So 52 months, that is 4 years. So 4 years, if you just save $4.99 per month on your own, because you're worried about a gas line break, in 4 years, you would have enough money to cover what the average cost to repair a gas line is. So I don't think this is good coverage for you. And in 4 years, if you save that money, you would have enough to cover an average gas line cost. Go ahead and answer practice question 8. When you're done, hit play to see how you did. So practice question 8. You're in the checkout line buying a new flat panel TV. As the clerk's ringing you up, he asks if you want to get an extended warranty. A 1-year warranty costs $50. 2-year warranty costs $85, and a 3-year costs $100. The television comes with a 1-year manufacturer's warranty. Most problems with a new television, or for that matter electronics, occur in the first 30 days. And there's about a 5% chance the television will have to be repaired during its lifetime. The average cost to fix a television is $187.50. Is this a good insurance purchase? Include calculations. So let's see. We certainly wouldn't want to buy a 1-year warranty because the manufacturer is already guaranteeing the TV for a 1-year warranty. And it says here the first 30 days is when that TV is going to break. So anything after this, in my opinion, is a waste of money because you have a 5% chance the television is going to break and it's going to need to be repaired. And if we luck out or we're unfortunate enough that a television breaks, the average cost is $187.50. So really what we're risking here, the choice between, let's say, a 3-year warranty on the television versus the average cost to fix it, $187.50 minus $100, which we would have paid for this warranty. So our risk here, what we're risking, is $87.50 by not buying the warranty. If we're given a kind of an average cost to fix the television, it could be more than this, but it also could be less than this. So really, what we're risking here is $87.50 by not choosing a warranty at all. So I would say, for me personally, I would not buy a warranty on this television because for a 5% chance, I will risk. So basically, looking at this in a nutshell, there's a 95% chance, because the television's only going to fail 5% of the time, that I'm going to save $100 by not buying this 3-year warranty. On the other hand, this is what I'm risking. There's only a 5% chance that I'm going to have to end up paying an extra $87.50. So it is definitely in my interest here not to choose any warranties on this television. So now let's go ahead and you should take a look now at the home project. Basically, the home project is going to take you through an insurance plan, and this is important stuff. Coming up with an insurance plan, not even, even if you're a single person here, coming up with a kind of a plan for health insurance is a great idea. When I went through and started putting this stuff together, I learned a lot of things about myself here and where I'm kind of lacking in insurance and where I am overprotected in insurance. So this is a great idea for you to go through. It will help you save money, and it will also help you make sure that you're covered correctly. So take a look at this, and this will give you some ideas. And when you get done with this, if you want to make some changes, then you want to definitely talk to your insurance agent about your ideas and make sure that it's sound and solid with them as well.